Good morning to the most incredible XRP army. I'm gonna waste no time, let's get right into the video. Let me tell you something that should absolutely make every single XRP holder sit up right now. If you're holding XRP or planning on getting any amount of XRP, you need to hear this. Imagine this. The worst case scenario for crypto in 2026 isn't as simple as just a price drop. It's a perfect storm of macroeconomic shifts, cycle-based momentum, and market psychology colliding. Fidelity's jury and timber has been clear. Bitcoin could fall to $65,000, Ethereum to $1,800, and Solana to $50 to $75, hitting key support levels that last cycle proved were crucial. He's looking at historical 4-year cycles and the natural rhythm of crypto markets, which suggests the highs we just saw at $126,000 could give way to a first-half drawdown. When cycles align with liquidity tightening and global macro turbulence, these dips aren't just possible, they're probable. What are the major predictions, and what does this mean for all crypto holders? Let's find out right now. So I need you, the amazing viewers, to get your coffees, get comfortable, and let's dive in. Hit the like button so this video reaches other amazing people just like you, and hit the subscribe button so you never miss an important update in the market. Now, amazing XRP viewers, let's get right into the good info. Tom Lee's recent Fundstrat projections add another layer of complexity. The leaked screenshot suggesting a $1,800 Ethereum target stunned markets, not because the research is speculative, but because it's an acknowledgement that equities and crypto might underperform simultaneously. Lee clarified this isn't his personal outlook. He still expects Bitcoin and Ethereum to be oversold, to bounce, and to hit new highs in January. The broader message is a volatile 2026 ahead, sharp corrections, rapid swings, and multiple points of entry for those with conviction and discipline. This duality, where some analysts see lows and others see a bounce, creates friction in trader psychology, which itself becomes a driver of volatility. Knowing who's bearish and who's contrarian helps position strategically without being swept up in panic or hype. Adding political context, the loss of Senator Cynthia Lummis introduces uncertainty into crypto legislation. Lummis has been instrumental in pushing forward Bitcoin strategic reserve initiatives, and her departure could slow progress in Congress. While her exit is a blow, crypto adoption is larger than any single lawmaker. Legislative momentum continues, with the Clarity Act and other bills potentially passing by Q1 or Q2, which would offer huge regulatory clarity and long-term bullish catalysts. Investors often underestimate how much political shifts can influence markets in the short term. Yet over the long horizon, digital adoption is unstoppable. The interplay between political risk and cycle risk sets the stage for market swings that may seem dramatic, but are predictable when mapped against historical precedents. 4-year cycles remain a contentious topic. Fidelity's analysis points to Bitcoin following historical halving-driven cycles, which could lead to lower lows in 2026. Global Macro Investor argues the 4-year cycle is broken, citing post-COVID shifts in public debt refinancing and interest monetization outpacing GDP growth. If the traditional cycle fails, we might see bases forming with plenty of chop before a sustainable rally, meaning consolidation periods that frustrate traders but create massive long-term opportunity. When cycles collide with macro liquidity tightening, volatility spikes, and market bottoms often appear ugly before they crystallize. Recognizing this pattern is essential. Corrections aren't failures. They're essential reset mechanisms that align asset prices with broader macroeconomic reality. The sentiment landscape adds another layer to the bear case. Extreme fear dominates the crypto market according to the Fear and Greed Index, while traders increasingly question the 4-year cycle. When sentiment reaches this depth of pessimism, even modestly positive catalysts can trigger outsized rebounds. ARK Invest and Cathie Wood emphasize this contrarian perspective, suggesting that despite short-term turbulence, 2026 could be a Goldilocks year, where macro pressures ease and inflation recedes due to falling oil and rents. Market psychology, particularly mass positioning and expectation, often drives price movements more than fundamentals in the near term. Extreme pessimism sets up asymmetrical opportunity. A small shift in confidence can trigger a disproportionate rally. Brazil offers a compelling microcosm of global adoption trends. Crypto activity in Brazil rose 43% in 2025, with average investments surpassing $1,000 per user. This is more than a statistic. It's a signal that emerging markets are maturing, user sophistication is increasing, and demand for low-risk digital products is growing. Global adoption rates, particularly in second and third world nations, will continue to pressure finite supply assets like Bitcoin and Ethereum. With 95% of all Bitcoin mined, but 90 to 95% of people worldwide holding none, scarcity is baked into the ecosystem. This fundamental pressure supports long-term upward momentum, even if macro cycles and political uncertainty create short-term volatility. Liquidity cycles and macroeconomic timing will dictate much of 2026's narrative. Analysts at Global Macro Investor argue that current cycles have been distorted post-COVID, with public debt and interest burdens outpacing GDP growth. These dynamics suggest that traditional halving-driven cycles may not apply this time, creating a broken cycle scenario. Yet this isn't inherently bearish. It just means that basing, consolidation, and chop periods could extend longer than traders expect. The market often rewards patience during these periods, providing superior entry points once liquidity conditions normalize. Understanding the underlying macro structure is critical to avoid panic selling and to recognize when risk-reward ratios are maximized. Tom Lee versus Fidelity represents the classic market tension between contrarian and cycle-driven perspectives. Lee sees oversold conditions creating January bounce potential, while Fidelity emphasizes historical cycles predicting lower lows. This dichotomy is important because it forces traders to consider both tactical short-term moves and strategic positioning. Ignoring one perspective can skew risk management, especially when market psychology amplifies swings. In volatile years like 2026, integrating both views allows for opportunistic entry and hedged exposure, combining contrarian timing with cycle awareness. Recognizing the interplay between sentiment, cycles, and macro liquidity gives investors an edge in anticipating both corrections and rallies. Altcoins without structural support are the most vulnerable in 2026. While Bitcoin and Ethereum maintain relative resilience due to adoption, liquidity, and scarcity, smaller altcoins can collapse under macro stress, especially if equities and crypto markets broadly correct simultaneously. Solana, for example, could test $50 to $75, illustrating that high beta assets face amplified risk during liquidity contraction. Investors must differentiate between structural and speculative assets. Those with fundamental use cases, network adoption, and liquidity are more likely to survive downturns and thrive when markets recover. Tactical rotation into robust L1s and DeFi protocols during corrections can yield superior risk-adjusted returns. Market bottoms rarely announce themselves clearly. RSI-based studies show that Bitcoin historically reacts sharply after oversold conditions, but these moves often involve significant chop and volatility before stabilizing. Fidelity points to the 65,000 to 75,000 range as a probable support, but traders must expect noise. Understanding that volatility is not synonymous with weakness allows disciplined participants to prepare for accumulation opportunities while ignoring headline-driven panic. Patience and recognition of historical oversold patterns can yield outsized returns for those willing to withstand short-term turbulence. Congressional and legislative developments remain key wildcards. The exit of Senator Loomis doesn't halt crypto legislation. If anything, it accelerates private sector involvement while Congress continues to draft initiatives like the Clarity Act. Exempting crypto transactions under $200 from capital gains tax, if passed, would remove friction from adoption and increase retail engagement. Legislative catalysts can trigger market-wide repricing events that dwarf technical analysis or cycle considerations. Recognizing political developments as real market drivers enables proactive positioning instead of reactive trading. 2026 is shaping up as a year of volatility with opportunistic entries, macro-driven corrections, political uncertainty, and adoption tailwinds. Whether you follow Fidelity, Fundstrat, ARK Invest, or Jordy Visser, the combined insights point to one thing: corrections will occur, but long-term structural support remains robust. Bearish scenarios down to $60,000 to $65,000 Bitcoin or $1,800 Ethereum are plausible. But these lows represent opportunity, not panic. Strategic accumulation during these drawdowns, combined with a view of adoption and scarcity dynamics, positions investors to capitalize on the next leg of the crypto bull cycle, with significant upside likely by 2027.